Welcome back. We frequently come across questions like how to value a company or a business. What is the right way to value a company? In this video, we will discuss the different ways to value a company or business with examples, their advantages and limitations. Before discussing these questions, let's first understand why do we need to value a company or business. Value of an asset is important to determine its net worth. It is the price that one has to pay to buy it. Value of an asset might be different for different people. For example, if we have a piece of land, the value of this land may be different for a farmer who would want to grow crops and then sell them in the market, and a real estate developer who would want to develop this land and then resell it. There are multiple ways how an asset can be valued. Normally, three ways of valuation approaches are used by equity analysts, investment bankers for making investment decisions, merger and acquisition decisions, leveraged buyouts, etc. They are asset based valuation, market based valuation, and cash flow based valuation. Asset based valuation is of two types, the book value method and the replacement method. Market based valuation again is of two types. One is the multiples based valuation and second the transaction value method. The cash flow based valuation is the DCF or the discounted cash flow method. It is also called the intrinsic value method. Let us look at each of them one by one. Book value method or the net asset value method. In this method, we look at the latest reported balance sheet of a company and calculate the net worth or book value of it based on company reported numbers. Book value or net worth of a company is the sum of total assets minus short and long-term liability. This is a reported balance sheet of a company. To calculate the book value of this company, we will take the total reported asset and then deduct the total reported liabilities to get the book value or net worth of this company. Book value method has some advantages and limitations. Let's first look at the advantages. The first advantage is that the net asset value can be calculated quickly based on reported balance sheet. Net worth is also available in databases like Bloomberg and Capital IQ. So if we have to get the net asset value for a list of companies, we can easily get them from these databases. The limitations of this method is that balance sheets are prepared based on historical costs. Therefore, book value of the asset may not give the true value of business or the company's assets. The accounting policies may also differ across companies or regions. Therefore, book value may not give the correct value of the business because of difference in accounting policies. Replacement value method. This method is similar to the book value method. The difference is that in the book value method, we take the historical cost or reported cost of the assets and liabilities, whereas in the replacement value method, we take the replacement value of assets instead of the book value. Replacement value means the price that one has to pay to get the assets replaced. This method is therefore based on current cost of assets and not the historical cost. Let's look at the advantages and limitations. First, the advantages. This method, as we said, is based on the replacement cost or current cost of the assets and not the historical cost. Therefore, it gives a better view of a value of a company. The limitation of this method is that it may be difficult to get the current or replacement cost of every asset as the price information may not be readily available. Calculating the value based on replacement cost may also be a tedious and time consuming process. Now, let's look at the market based valuation methods. The first one, the multiple based method. This method is quite often used by equity analysts and investment bankers. In this method, we value a company based on multiples of similar listed companies. Multiples used can differ by circumstances. For example, we can use the enterprise value to revenues multiple or price to sales multiples for startups or loss making entities. Earnings based multiples are generally used for valuing profitable companies. The earning based multiples are EV EBITDA, EV NOPAT, PE multiples, etc. Asset based multiples like price to book or EV to invested capital are used for financial companies or companies which are highly capital intensive. This method is also called the relative valuation or comparable company valuation because it is based on data or valuation of other companies. Here is an example. We have 4 companies and some information on revenues, EBITDA, net income, and EPS, and the current share price and enterprise value of the companies. We can calculate the multiples of these companies based on these data points. So here we have the EV to revenue multiple which ranges between 1.9 to 2x, the EV to EBITDA multiple which again ranges from 10 to 14x, and PE multiple which ranges from 10 to 12x. So if we have the data, the basic financial information, and the value of the listed companies, we can easily calculate the multiples for these companies. There are a few advantages and limitations of the multiples method. Let's look at the advantages. This method is simple and provides a quick estimate of value of a business. We get a ballpark range by using different multiples like the earnings multiples, asset-based multiples, or revenue multiples. The limitations of this method are that this method values a business based on current market valuation. It does not consider factors like performance on growth, return on invested capital, or forward expectations. Also, it is sometimes quite difficult to find companies in similar businesses. Let's look at the transaction value method. This method is similar to the multiples based valuation approach. It is used to value a business or segment of a company, usually in the case of mergers and acquisitions. In this method, we take the transaction value multiples for past deals to estimate the value of the business or segment being looked into. The transaction value multiples could be transaction value to EBITDA multiple, transaction value to revenue multiples, etc. Here we have 4 previous transactions. So company A acquiring company X, company B acquiring company Y, company C acquiring company N, and company D acquiring company Q. The acquired company's revenue and EBITDA is given, and we also have the transaction value for these past deals. Based on the information given, we can calculate the transaction value to revenue multiples and transaction value to EBITDA multiple to get a range of value for the business or segment being looked into. The transaction value method also has a few advantages and limitations. Let's look at the advantages first. This method again is a simple method and provides a quick estimation of the value of a business. We can get a range using different type of multiples like transaction value to revenue multiple, transaction value to EBITDA multiple. The limitations of this method are that this method values a business based on prior transactions. It does not consider other factors like performance on growth, return on invested capital, forward expectations, etc. Also, it may not be easy to find similar type of recent or past deals. Let's look at the discounted cash flow method. Discounted cash flow method is also known as the intrinsic value method. This method involves estimation of cash flows generated by a business over long term and then discount the cash flows to present time. Present value of cash flows till perpetuity over long term is the intrinsic value of a company. Estimating future cash flows requires good understanding of the company, business, and the economy. DCF valuation method usually involves 5 steps. The first is to understand the business being looked into, then analyze the historical performance, project the future cash flows, calculate the terminal value of the business, and then discount the cash flows using cost of capital to present time. Discounted cash flow method is usually or mostly used by investment bankers and equity analysts, but this method also has a few advantages and limitations. Let's look at the advantages. So this method calculates the intrinsic value of the business based on future cash flows. This method looks at the performance and future expectations of the business and is not based on value of other companies like the multiples method or the transaction value method. This method is quite detailed as we need to understand the historical performance of the business and then project the future cash flows till perpetuity. This method helps do sensitivity analysis by changing few levers like growth, margins, capex, etc. And we can also build scenarios using this method. So a discounted cash flow method involves building a detailed financial model, and we can use this model to build multiple scenarios. Limitations of discounted cash flow method are as follows. This method is complex and time consuming. It is dependent on multiple assumptions like growth, margins, capex, etc. If the assumptions are not correct, then this value will not give the correct value of the business. Terminal value in this method represents large portion of the total business value of the company. Calculating cost of capital may not be straightforward. There may be industries where cost of capital may differ significantly across players because of various reasons, and calculating the correct cost of capital in such situations may be difficult. While discounted cash flow method is the best method to value a company or business as it is based on future cash flows. It may not be feasible to always use a discounted cash flow method due to business complexity, industry complexity, cash flow uncertainty, etc. Equity analysts, investment bankers use all valuation methods to triangulate and understand the value estimated by different methods. Hope you enjoyed the session. In case you found this video useful, please circulate it with your friends and colleagues. Thanks again for watching. Wish you all the best.